From our Stars and Dogs segment, it's time for this week's Dog.
This week, our dog is actually a company we do not cover, but we monitor closely as it checks off some of the boxes that we look for in a growth stock or small cap investment. The company is Exfo Inc., EXF on the TSX. What does Exfo do? They develop smarter network test monitoring analytics solutions for the world's leading communication service providers, network equipment manufacturers, and web scale companies. The stock dropped, however, 6% just today and has dropped 13% over the past week. Why? Well, the company disappointed on the earnings front in its third quarter, which were reported late yesterday. Its net loss was around 8 cents per share compared to net earnings in the same period last year of 2 cents, and those are both in US figures. Now, we do note that the loss was not nearly as bad as it appeared, as it included a $3.6 million in after-tax restructuring charge. What was disappointing, though, was the company reported it will now miss its 2017 EBITDA guidance. To quote the management team directly, they will now fall short of their $26 million adjusted EBITDA target for the year, with adjusted EBITDA of just $13.5 million after 3 quarters. There's a delay in spending by communication service providers. We've heard about that on some other companies we look at, on a large system-based solutions and on non-profitable passive wireless monitoring product lines, which prompted the company to revise its expectation. They were guiding, like I said, for about $26 million in adjusted EBITDA. Now they're looking at $20 million for the full fiscal 2017. Now, they did implement a restructuring of part of their business in May of this year, and that resulted in a $3.8 million restructuring charge in the third quarter. That is short-term pain for potentially a long-term gain, because it is expected to generate some annual cost savings in the range of $8 million US going forward. Part of that will be eaten up by investments in a recent acquisition they made for growth, but that is for growth capital. So they're at least investing in a growth area of their business and taking money away from a losing part of their business where they lost money. Now, the restructuring that they're doing right now and the go-to-market strategy with some new products should begin to benefit the company in the fourth quarter, so the upcoming quarter, but the full impact will likely not be felt until fiscal 2018. Our take right now is that Exfo has a very strong balance sheet. There's about $34 million US in the bank. That's about 85 cents per share, which is around 15% of the market cap. There's no debt. Our issue with the business historically has been on a quarter-to-quarter basis that earnings can be very unpredictable and lumpy. Once again, this formula has played out in 2017. Now, we want to monitor and want to keep monitoring the company closely, as like I said, it checks off a decent number of our boxes in terms of investment quality, and there may be an opportunity here if the share price slumps further going into 2018. Now, the losses this week make it our dog of the week, but we do consider the business, we do not consider it a long-term loser. There is a potential for solid growth heading into 2018, so we'll monitor the situation and see if there's some value and an opportune entry point potentially at the end of this year.